When I started my stock market trading around 20 years back, one of the first indicator I used was moving average. I read it in some books that whenever fast moving average crosses above the slow moving average, that means it's a buy, or whenever fast moving average closes below the slow moving average, that means it is sell. And that is what first time I learned about the moving average crossover. And I started using that in my trading. Initially, as they say that beginner's luck, I was making profit for a few days, and suddenly I started making losses, and then I dropped the idea of using moving average. Then I went to many other indicators like RSI, Stochast, Bollinger Bands, Ishimoku, and all these, and still I was not convinced with any other indicator. And again, I came back to moving average. So what I realized is, if moving average crossover is not working, doesn't mean that moving average itself bad, right? After that, I started using moving average in my trading. And after that, in last 20 years, I learned many secrets about using moving average. And that is what the objective of today's video. In this today's video, as a part of chart reading masterclass, I'm going to discuss total 7 secrets which I learned being in stock market for last 20 years. So if you are also a fan of moving average, just like me, then you should watch this video till the end, because I'm going to discuss 7 top secrets which I learned after using moving average. And the first secret is EMA is most powerful than SMA. There are many types of moving average. The most commonly used moving average is EMA and SMA. EMA stands for exponential moving average. SMA stands for simple moving average. And if you watch my old videos, I always give credit of learning how to use moving average from Oliver Velez. Oliver Velez is an American-based trader. After watching his YouTube videos, I really learned how to use moving average. But only difference is, in the Oliver Velez video, he always says that he uses only SMA, simple moving average. But with my experience, with my backtesting, what I've seen, exponential moving average is much more powerful. They say that EMA faster and SMA is more accurate. But what I learned in last 20 years that EMA is not only it is fast, but it is accurate also. So that's why if you ask me which is better, EMA or SMA, I highly recommend to use EMA. Now let us see a couple of charts to know why EMA is better than SMA. For example, look at this chart. You know that EMA is always powerful when it is trending. The red line what you are seeing, that is the SMA, and blue line what you are seeing is the EMA. Okay. So you can see from this chart itself is that price took the support near the EMA, and here you can see that price broken the SMA 20, both are 20, and here it was not giving any proper indication whether it's a reversal or taking support, but you can see that price started taking support near the 20 MA rather than SMA, right? That's why I say that EMA is the most powerful compared to SMA. 16th November also you can see that here price started breaking below the SMA, right? But where it took the support exactly near the 20 MA and then started going, right? So that's why if you ask me my suggestion, I would say that instead of SMA, start using EMA. Okay, and the second secret is there are many kind of moving average like 5, 8, 20, 50, 100, 200. There are so many types of moving average, and I always say them 20 and 50 is the most powerful moving average. So if you are also confused which moving average is the most powerful, I would highly recommend you to have 20 and 50. More than 50, 20 is the most powerful. So why I am saying that 20 and 50 most powerful, that I will tell you in my next segment. Okay, why I am saying is that 20 and 50 is most powerful, and how I use 20 and 50. So 20 moving average is most ideal. That means by now you already know that moving average is most powerful whenever market is in the trend, right? For example, you can see here, this is the 50 MA, green is 50 MA and blue is 20 MA. And you can see here, sometimes market can break the 20 MA and can give you impression that it is going up. But most of the time I've seen that instead of going up, it takes resistance at the next EMA, that is the 50 MA, and again it reverses. So that is the most commonly seen. So that means 20 and 50 moving average are used as a support and resistance, especially when it is trending. So earlier I also done mistake. Whenever it breaks the 20 MA, I used to think that oh, it is going to go up, and only it used to reverse. But after that, plotting 20 MA, 50 MA, I realized that I should use both 20 and 50 MA as a support and resistance. For example, you can see in this chart also, it is the strong trend. Earlier, it took the support near the 20 MA. Then it started breaking and going below the 20 MA. But again, it took the support from the 50 MA and started going up, right? Had you not plotted 50 MA, then maybe you would have taken a short trade thinking that it has broken the 20 MA and it will go down, only to see that price again goes back and hitting your stop loss. So that's why what I want to suggest you is that have both 20 and 50 MA, even though sometimes it breaks 20 EMA, then most of the time it can take support near the 50 MA and goes up. Only if it breaks both 20 and 50 MA, then most probably it's a sign of reversal. Okay, and the next secret is, as you know that 20 MA is most useful in trending day, right? And most of the time it takes support. So whenever there is a breakdown from the 20 MA on the trending day, it can be upside or downside, it is most chances of reversal. For example, this is the 16th November. You can see that it was in the strong uptrend. It looked like market will close at the high of the day. Only you can see that at late afternoon, it made a big bearish candle and broken the 20 MA. So what I'm trying to say that even on trending day, most of the time, I wait till the late afternoon for taking the reversal trades. That means if I see that candle has broken the 20 MA in the late afternoon, remember this again, I'm talking about the late afternoon. That means after 2:30 like that. Not like 11 o'clock, 12 o'clock, 12:30 and all this. Only in the late afternoon. If you see this kind of price action, that means entire day it was in the strong trend, and late afternoon it's broken the 20 MA with a powerful candle. That is the indication of most likely a reversal. So shorting this candle can get a good trade most of the time. The reason is most of the people who went long here, they are going to get trapped because they thought market will go like this and closes at high of the day, only to see reversal and the stop loss getting hit. So that is what 20 MA can also tell you about the trend reversal, especially in the late afternoon. And another example you can see here on 8th November also, it was in the uptrend, right? Moving average on the uptrend. And you can see that somewhere in the after 2 o'clock, it looked like it is going to go up and suddenly it started coming down, right? Many people must have thought that it will go like this and suddenly it started making a bearish candle and breaking the 20 MA. So that is a sign of market reversal. But what I said, only in the late afternoon. For example, here also it reversed, but don't trust it as a reversal because most of the time it can again make a fake breakout. So that's why if it happens in the late afternoon, like earlier example, how we have seen, most of the time it can be a trend reversal, and shorting the candle which breaks that 20 MA can give one of the best. And the next secret is whenever candle opens at the 9:15 candle, first candle opens with a big gap up or gap down, and it is too away from the 20 MA, candle open is here, first candle, and 20 MA is here. So whenever I see this kind of setup, that means it is a chances of reversal, mean reversion. That means it's a chances of reversal back to 20 MA. Rather than going long here because gap up means it's a bullish sign, going short can give you high probability trades. Okay. So that is what this secret is. Price have tendency to come back to the 20 MA just like a rubber band. When you stretch a rubber band, it comes back to its original position. Same way 20 MA also. Price also, whenever it is too away from 20 MA, it has tendency to go back to 20 MA. So that's why next time when you see that price opens with a big candle away from 20 MA, then instead of going in that direction, going in opposite direction can give you a high probability. So for example, instead of opening gap up, if candle opened gap down and made a huge bullish candle like this, that also instead of going short because of the gap down, going long here on the first candle can give you high probability trades because price have tendency to go back to the 20 MA most of the time. So that is the one of the secret which I have learned being in market for last 20 years. So this is what we discussed in one of our strategies with my new course, that is Mastering expiry day trading course where I discuss this setup in my new course. So in mastering expiry day trading, I said whenever price opens 2 away from 20 MA, then you can sell call option. Okay. So this is specially for option sellers. Option buying also you can do it by buying the put option. But sometimes what happens, instead of going immediately like this, it can stay sideways for very long time like this. Then if you have bought option on expiry day, because of the theta decay, you can still lose money, even though direction is not wrong. But selling call op can still give you profit, because when market stays sideways, option sellers make money, right? So that is what I discussed in my new course, Mastering Expiry Date Trick. Look at this. EMA 20 EMA is here. Candle opened here, right? So it is 2 away from 20 EMA. I discussed just now. It can be gap up or gap down, but whenever price opens 2 away from 20 EMA, chances of price going back to 20 EMA becomes higher. If you look at 6th November also, price opened with a gap up. Opening is here. 20 EMA is here. Instead of buying, going long, taking a short position can give you high probability trades, because price have tendency to come back to 20 MA, just like when you stretch a rubber band. And the next secret, what I observed, that on, especially on daily time frame, whenever candle opens right near the 20 MA, sloping 20 MA, then those days most of the time can lead to big trending day. For example, you can see that it's a sloping 20 MA. This is 10th November and this is 6th November. Both opened near the 20 MA, and you can see that how big that candle was. So big green candle, that means it was a big trending day. So what we'll do, we'll mark that level on both candle where was 20 MA. So this is the 6th November and this is the 10th November, right? Now let's go to 5 minutes time frame and let us see. So you can see that this is the 6th November chart, and you can see that the black line which I marked it on daily time frame, and you can see that price took the support here, took the support here, took the support here, then it made a huge trending day, right? After taking support third time near the 20 MA, then look at this, how big that day was, huge trending day, right? And again, second example we have seen on 10th November, right? Let's go to 10th November, and you can see that 10th November also 20 MA was here, right? So you can see that for some time, price started taking support near the 20 MA, near the 20 MA on daily time frame. And after that, it started making a huge move on the upside. And finally, price closed here, making a huge trending day, right? So that is what I have observed. Whenever there is a 20 MA on daily time frame, and that day, price also opens near the 20 MA, can lead to big trending day most of the time. And the seventh and last secret is, instead of blindly trading on sloping 20 or 50 MA, if you want high probability trades, then along with sloping 20 and 50 MA, if there is confluence of any other support or resistance, that can give you very high probability trades. That means 20 and 50 MA is as very powerful, but along with that, there is any price action support or resistance that can give you very high probability trades. For example, you can see that this is 23rd October. Price took the support somewhere here, and finally breakout happened, right, with this red candle, and then started going. So now what is the previous strong resistance? This is the previous strong resistance. Why this is the resistance? Because if you know the price action, that support, once it is broken, then it becomes a resistance, right? That is what the price action is. Support was broken here, then it became resistance, and you can see that it broken the 20 MA. But what I said, even though it broken the 20 MA, sometimes it can take resistance from 50 MA, right? That is what we discussed in earlier. And you can see that now it started taking resistance near the 50 MA, but same time there was another resistance. So that is what known as confluence of resistance. It can be support resistance, it can be CPR also. If you see any other resistance along with 20 MA, along with 50 MA, then it's a high probability. You can see that again it took the resistance at the same level, which was the red level here, and then you can see that then it made a huge collapse on that, right? Here also you can see that, as I discussed earlier, it went above the 20 MA, took the resistance near the 50 MA and closed. So that's why I said have both 20 and 50 MA on your chart. Another example you can see here on 29th September also in Bank Nifty, it was a big trending day, and you can see here it broken the 20 MA, but what I said, price have tendency to come near the 50 MA and again it can bounce. It bounced again it broken the 20 MA but took the support near the 50 MA and then started going up. So what is the high probability? High probability trade is, for example, this candle high is the strong resistance, right, which was broken here. So what you can do in such case, make a box there, that is where price broken with this candle, right? So this was a resistance, right? When price came here, it becomes support, right? Because resistance, once it broken, then it becomes support. So you can see that clearly price started taking support near the 20 MA, then that also broken, but near the 50 MA it started taking support and started going. So that means taking a long trade near that red level would have given you high probability. Though 20 and 50 MA very powerful, but same time, if there is any confluence like this, such time it can give you high probability trades. So that is what I wanted to discuss through this video about whatever the 7 secrets I learned using moving average after being in market for almost 20 years. But same time, remember, in trading, there is nothing like 100%. Whatever I discussed, it's not that 100% of the time it works. Sometimes it can fail also. That's why stop loss is mandatory whenever you are doing trading in the market. So that's about today's video, guys. Let me know in the comment section, how did you find this video? And if you want to learn more about price action, more about strategies for day trading, then check my course, that is 25 day trading strategies in Nifty Bank Nifty, where I discuss almost 25 strategies to use in day trading. So that's it, guys. I'll see you soon with a new video. Until then, bye and take care.